So you probably clicked on this presentation because you're either holding StoneCo stock or you're thinking about holding it. And this is a company that was raised to us by our readers and subscribers. So if you are holding shares of StoneCo, you're in good company. Warren Buffett and ARK Invest are just two notable institutional investors holding StoneCo. Now, we're going to talk today why we're not holding it, nor would we consider holding it. And we'll start out with an example here. So I worked as a hiring manager for around a decade. And whenever we would hire people, we focused only on competency. But these days, you have what are called DEI departments that want to have hiring managers consider other attributes than competency when they're hiring. So they look at things like the racial breakdown of a company's employees. So if they were going to do their jobs perfectly, then they would want to mimic global population. So if you had 1,000 employees, you'd start by hiring 1 Cuban, then 2 Rwandans, 3 North Koreans, 4 Yemenis. And then on the other side of this distribution, you'd have 187 Chinese people. So that's quite interesting to think about, that if you had 100 employees in a company, that almost 19 of them, nearly a fifth, would be Chinese. Then you have Indians, Americans, and 28 Brazilians. So Brazil is actually the 7th most populated country in the world. So it's a place where there's a lot of opportunity to be had, and that's where StoneCo operates. Now, Brazil is as corrupt as Indonesia and rich as Russia. So there's in any of these BRIC markets, so BRIC stands for Brazil, Russia, India, and China. These are emerging markets that experts have said offer the most potential, and they certainly do, but they also offer up a lot of risk. Now, Brazil is the largest fintech market in Latin America, 5th largest in the world. There's about 700 startup companies trying to tackle that opportunity. And the one that StoneCo is looking at would be the 30 million micro, small, and medium-sized enterprises in Brazil, which account for 30% of the country's GDP. StoneCo services about 2 million of those. So you could say that they have under 10% market share, though these numbers can always differ based on who's providing them. But we pulled this number of 30 million from it was the U.S. Embassy in Brazil. So when we're looking at the opportunity for StoneCo, here's one of the products they provide. It's pretty easy to understand. So they offer small businesses or micro businesses these machines that allow them to take payments from credit card companies. And you can see here that depending on what rate tiers you choose, if you're looking at the top there and you go to the right, you see how the fees that they're paying increase as you move to the right. Well, when you change that button, it will change the pricing below for the machines. The machines become less as the tier as you move to the right, but you're paying more fees. And if you're wondering what that 12x credit is, that's quite interesting. That's where a merchant can offer a customer the ability to pay for something in installments. And when they pay back those installments, the merchant receives less and StoneCo takes their cut. These are some pretty steep rates. So this is an example of the sort of products that StoneCo offers small, medium, and micro businesses in Brazil. Now, if you have been paying attention to the price of this stock, it's been quite the roller coaster. So they had an IPO in October of 2018. Mr. Buffett, who doesn't like participating in IPOs, actually bought in at that time. And then it breached $90 a share early last year. Today, shares traded around $8.50, following an 85% fall over the past rolling year. Well, what happened? When you look at their financials, it's quite puzzling because 2018 was when they had their IPO, and you can see moving to the right that things have gotten pretty good, with the exception of 2021, where revenues hit nearly 6 billion. This is in Brazilian reals. So just pay attention to the trend, but they started losing money. Well, what happened, and probably a pretty good chunk of the decline in share price can be associated with the decline of their what they call their legacy credit portfolios. So one of the things that this firm was doing was lending money to businesses. Earlier, we gave you the example of how a customer might buy now and pay later. We're familiar with that. Well, we don't like that at all, no matter where it's offered. So BNPL in the United States, you don't actually need to qualify somebody before you offer that. And there's the likelihood that people will abuse it. Well, in Brazil, they only implemented a credit scoring system a decade ago, so they're quite behind. And lending money to individuals or businesses in markets like that, you can run into a lot of problems, and that's exactly what happened here. StoneCo published a paper on this, and I'll link to our research piece that we used to produce this video, and you can read this research piece from StoneCo that talks about how they ran into problems, and they blame the Rona and regulation changes and a number of things. But the problem that you can see here is that if you read the numbers along the top, that's the value of their credit portfolio. And then along the bottom is the fair value on their balance sheet. So if they're expecting to loan people money and get all of that money back without charging interest, then you would expect those two numbers to be about the same. So what you see here is that top number declining and the bottom number declining just as fast. So in the most recent quarter, they have 722 billion reals outstanding, and they only expect to get back 268 billion. Well, what does this mean in US dollars? This is about 650 million US dollars that they loaned out starting about 3 years ago, and then they stopped loaning money in the middle of last year because they were running into problems. And what they expect is that the $650 million, they're going to get it all back with some change. So they didn't lose money, but they certainly didn't make money. And the problem there is that when you look at the monetization opportunities that they spell out, you can see here on the right-hand side where they expect to get money. You see banking, insurance, credit. That was a big chunk of where they expected to be making their money. And when that failed, then investors punished them. And on the left here, you can see this is in their last investor deck, their last earnings call. They talk about credit product update. So the status that they're moving towards resuming those disbursements, and they have 5 major fixes. They've revamped the product to simplify the experience, personal guarantees, better risk monitoring. These things are very tricky when you're going and loaning small businesses money in a emerging market. So when we look at how they're making money, so they have about 2 million clients that they're making those payments fees from on their payments platforms, and they're converting some of those, about a quarter, to banking clients. So these banking clients have deposits of about $380 million. That's about $736 per business, very small balances. Each of these clients generates an average of $6.28 in revenues per month for StoneCo. Not sure where that money is coming from, because they kind of blend everything together and talk about insurance and card interchange fees, transaction fees. So the idea there is that they want to convert all these businesses to banking clients and sell them products like insurance. Now, one problem they're running into, along with their competitors, remember the Brazilian fintech market is extremely competitive, as we mentioned earlier, is that the high Brazilian interest rates are creating problems for them. So they're being running into, let's say, curveballs left and right when they're trying to operate against Brazilian banks and build out their business. Now, other considerations here, aside from the fact that it's a very competitive environment, is that the banks in Brazil won't take it lying down. So you can see some of the regulation changes in that paper that StoneCo put out. There's legal risks, and in other markets, sometimes banks, especially those operated by the government, will play dirty. So you need to compete against that on an uneven playing field. And there's the cost of acquiring new clients, right? So a lot of firms will subsidize new clients just so they can build market share. That becomes costly. And it starts to beg the question, just how profitable is this business if you're a leader? And you saw earlier that they used to be a profitable business and now they're losing money. This question was raised by a JP Morgan senior analyst in the latest earnings call. He talks about how StoneCo used to have margins of 40%, lower market share. He said they have about 10 to 12%. And numbers don't quite add up, but that would mean at 10%, they should have 3 million, not 2 million. But again, as we said earlier, the estimates of the total opportunity differ. But at a lower market share, you expect lower margins. But then when you become a leader, and apparently the leader right now in that market has about 25%. And if StoneCo can keep their double-digit growth, strong double-digit growth, then maybe they can take that leadership position away. Again, at what cost? But where do those higher margins come from? Is it fixed cost dilution? So they have, these fixed costs and more revenues, then you dilute away, right? And you expand your margins. So the company's response was that they were going to increase prices, of course, cost dilution, and that they want to move 75% of their clients that aren't on banking to the banking platform with a strong focus on profitable clients. So we'll see how that pans out for them. But when you look at the valuation of StoneCo, it's certainly not overvalued. When this is a simple valuation ratio, which simply takes market cap and divides it by annualized revenues. I think in our catalog, most firms would be considered low, anything under 5. Well, this is pretty low at 1.8. So it's certainly not overvalued. But again, they were punished by investors because of that loan debacle. They have a new head of credit and they have these plans to turn things around. But this isn't something we would be interested in at all for a number of reasons. First of all, it's not an easy business to understand. So I spent a meaningful amount of time pouring through their investor deck. It took me a long time just to figure out what the acronym TON meant, and that's actually one of their products. This is not an easy business to follow, which is curious as to why Warren Buffett got involved in this. And maybe it was a simpler business before they started making acquisitions. They recently acquired a company called Lynx, I believe. We didn't even dabble in looking at that aspect of their platform because just figuring out the basics was difficult enough. Revenue sources, as I said, on the banking side are extremely opaque. We're not sure where that $6 is coming from. Now they're selling insurance. It all becomes quite difficult to decipher, and they're operating in a very competitive environment. Again, the cost to continue growing against clients, against government banks, this becomes very difficult. So they're up against a lot, and this is a single country. We hate investing in countries, or say companies that have exposure to a single country, because there's a lot of risk. What happens when things go pear-shaped in the Brazilian economy? Well, they're going to be in a world of hurt. So this isn't a company that we would consider investing in at all. And when you look at the BRICS, China, Russia, Indonesia, I personally spent several months in Indonesia scouting tech startups and learning about that environment, which is quite far behind others in terms of where they're at with AI. But you have in Jakarta 5 different databases that provide unique identification numbers for people, and there's a fair number of duplicates. So you might have the same, what's in America, social security number as somebody else. These countries have a lot of problems. There's religious beliefs that come into play. There's corruption in the government. There's volatile currencies. There are a million things that can go wrong. And when you're investing in a firm that only operates in a single country where a lot of bad things can happen, it's not that good of an idea. And again, going back to that comment on the margins, we're not even certain that the upside, the reward, the pot of gold at the end of the rainbow makes it worth it. So StoneCo is certainly not a company that we would be considered investing in at all. So please leave your comments in the comments section. Make sure to subscribe to our channel. Thanks so much for taking the time to watch this video today.